Hi there. So my name is Yasmin and I'm a tutor here at Tutor Impact. And today we are going to be discussing an introduction to UK company law. So you might already have a bit of knowledge about this already, or at least what a company is. Obviously, there's quite a lot of companies all around us. You walk down the street and you see different companies like Tesco, like Urban Outfitters, like Boots. All of these are companies. But today we're going to be discussing what that actually means. And we're also going to be looking at different ways in which you can run a business. So we're going to answer that last question first. And we're going to firstly look at ways of running a business. So there are three main structures when it comes to running a business, and you might not have heard of these before. So the first one is a sole trader. So this is the simplest type of business form, and it's where there's one person who owns and operates the entire business, and they can also hire others to help them. But they're at the front of it all, they're dealing with everything and they're organizing everything. So it's just one person running the whole enterprise. And that's what a sole trader is. The second one here is a partnership. And that occurs where two or more people run and own a business together with a view to make a profit. So it is a bit similar to the sole trader, but instead of just one person in control, there's two or more working together to run the business. So yeah, it's slightly different, but similar in the sense that it's just one or two or more people running the business. The last option here is the limited company, which is probably the most important type of business structure. And it's what most people mean when they talk about companies in general. So a limited company is the short version of saying limited liability company. And this is formed by registering certain documents. And the result of this is to create a separate legal entity. Now, don't worry, we will be talking about this later. But what this means is that the company is an entity in its own right. This means that the people who own it are quite irrelevant in terms of this. So when a company does an action, this action is attributed to the company rather than the people who run it. So it's completely regardless of who owns or runs the company. As I said, we'll go on to discuss this in more detail next, but this does offer more protection than the other two models. Like I said, we're now going to go into a bit more detail on each one. So the first one, as we discussed, is the sole trader. So as I said, that is where an individual runs a business, they own it, and they have the right to make all decisions affecting that business. So they can pretty much do whatever they'd like with that business. But this also means that they're responsible for paying any tax on money the business makes, and they're also liable to pay any debts of the business. What this means is that if the business owes anyone any money, it is the individual who runs the business who is personally responsible for paying that off. So say, for example, a sole trader borrows £100 from the bank. It is that individual who runs the sole tradership who is personally responsible to pay back all of that £100. So this is considered a disadvantage of the sole tradership because it means that that person has unlimited liability, which means they could have to pay back an unlimited amount of money depending on how much the sole tradership owes. But this model does come with some advantages. For example, they're easy to form and they obviously have the freedom to run as they please. And then any profits that are made in the sole tradership, they can go directly to the owner. So the person who runs the sole tradership gets all of the profits. So in summary, we have the advantages, which are that it's easy to form, they have the freedom to run it as they please, and all profits belong to the owner. And then the disadvantage is that there is unlimited liability for any debts of the business. So that is the sole tradership, and we're now going to look at partnerships. So as we said before, a partnership is where there are two or more people who are running and owning a business together with a view to make a profit. As with the sole trader, it's very easy to form as it only requires a minimum of two people, and those two people or more have the freedom to run it as they see fit. As I said, this is quite similar to the sole trader, other than the fact there are two people rather than the one. So, but the additional benefit, of the partnership is that because there are more than one person running the business, this means that they have the support of joint decision making. So if there is a big decision to make, it means that the owners have each other to sort of discuss and rely on when it comes to making decisions, rather than there just being one person in control. Similarly to the sole trader, however, the partners are liable for the partnership debts. So just like with the sole trader, the partners are jointly liable for any debts that are outstanding. So taking the same example we had before with the bank, if the partnership were to borrow £100, it is the partners who are personally and jointly liable for that debt to be repaid. So all of the partners would have to ensure that that was paid. And again, their liability is unlimited. So that's the main advantage and disadvantage of partnerships. And now we're going to go on to the limited company, which is, as I said before, is probably the most important structure in terms of businesses. So as I said before, a limited company has separate legal personality. What this means is that when a company does something, that act is the company's own act, and it is not the act of the people who run the company. So if the company enters into a contract, it is the company who is entering into that contract and not the owners of the company. And this concept of separate legal personality is very old. It was set out in the case of Solomon v. Solomon, which was a 1897 case. So as I said, it's quite an old concept that's been going on for many years. So we're now going to discuss the consequences of separate legal personality. And so as you can see, the first one is that the company owns all of its own property. So any company property belongs to the company and not the owners of the company or the people who manage the company. Similarly, a company, as we discussed before, can enter into contracts in its own name. And this is because it's a separate legal entity. So just as me and you could enter into a contract with someone, a company can also do this. And then the next one is a company incurs debts in its own name. And this is what we spoke about before. So unlike sole traderships and partnerships, it is the company that is under a duty to repay its debts rather than the people who run the company, as those people in general will not be liable. So taking the £100 bank loan example again, so if the company took out a £100 loan from a bank, it is the company who is responsible to pay that back and not the people who manage or own the company. So for the rest of this presentation, we're going to focus on the limited company structure of running a business, just because, as I said, it is the most important, and quite a lot of businesses adopt this sort of structure just so they have the additional protection that is offered by separate legal personality. So as I said, we're talking about the limited company here. So companies in the UK are governed by the Companies Act 2006. So this is the piece of statute which was created by the government to manage companies in the UK. So this stipulates the majority of the rules governing companies, including registration and their management. It has all of the rules that are set out in terms of procedure that need to be adhered to when running a company. We're not going to go into those in detail today, but all of the rules are set out in that place. Just briefly as well, the main two actors in a company are shareholders and directors. So shareholders, in very simple terms, they own a portion of the company, and in return, this allows them to vote on certain company matters. And when the company is making money, it also means that they can receive money in the form of dividends, but this is only when the company is profiting. I've written here that they're sort of like owners in a very loose sense, just because they do own the shares in the company. On the other hand, we have the directors, who have a much more active role, as they are in charge of the day-to-day management of the company. So this includes entering into contracts on behalf of the company and making decisions as a board of directors. The board of directors is just all of the directors when they have a meeting to discuss matters of business. They all sort of meet together to make a decision. But although these directors do have a lot of control over the company, they have a lot of involvement in the day-to-day management of the company, this does not mean that they can do whatever they please. They are limited by the Companies Act, which we discussed before, and they're limited by what is known as directors' duties. So we're now just going to look at a couple of these duties in very brief outline, just so you have an idea of what they're constrained by. So the first one that we have here is the duty to act within powers. So what this means is that when a director is acting in the course of business and in the day-to-day management of the company, they must only exercise powers that are conferred to them under the internal rules of the company. What this means is that if a director wants to enter into a contract, he must be authorized to do so. So the director could not just go off and enter into contracts on behalf of the company unless he has been authorized to do so. So that's acting within powers. The second one here is to promote the success of the company. What this one means is that a director must act in good faith to promote the success of the company. This might seem a bit straightforward, but basically means that, for example, if a director was entering into a contract, he could not enter into that contract if he knows it will negatively impact the company, because obviously that is not promoting the success of the company. So yeah, whenever directors are acting, they must promote the success of the company. The next one is exercising independent judgment, which is quite straightforward. And then we have exercising due care, skill, and diligence. So there's sort of two sides to this. There's the objective limb, which looks at this duty in terms of a general director, so it doesn't take into a director's specific knowledge or experience. And it looks at whether that director acted with general knowledge, skill, and experience that would be reasonably expected of someone in his position. Whereas the subjective element of this takes into account what that director actually does, his experience, his role, and it's whether that director acted diligently as a person with his general knowledge, skill, and experience does. So they have to exercise with due care, skill, and diligence as they are carrying out their duties. The next one here is the duty to avoid conflicts of interest. So directors must involve situations which risk having direct or indirect conflicts of interest. What this basically means is, in simple terms, again, a director must not make a profit from being director, even if the company also profits for it. However, there is an exception to this rule, and this is where the company authorizes the director to have a conflict of interest. So, for example, if a director was making £500 out of a deal, obviously this would be a conflict of interest, but if the company allowed this, then there wouldn't be a breach of duty here. The next duty is not to accept benefits from a third party. Again, this one's quite similar, but if you're given benefits because you're a direct director, you're not allowed to accept them because obviously this is breach of this duty. The only way you can accept them is if it is reasonably regarded as unlikely to give rise to a conflict. So if it's something small or something negligible, then it wouldn't be an issue. So, for example, corporate hospitality is generally allowed. So, if your client bought you a coffee when you were organising a deal, obviously that's a benefit, and it's a benefit that's derived from you being a director. However, it's not out of the ordinary, and it's not substantial enough to give rise to a conflict. The last duty here is to declare interest in proposed and existing transactions. So what this one means is, if you are a director and you have an indirect or a direct interest in a transaction or an arrangement with the company, you just have to declare it. So it's very simple procedural duty that you just have to declare any sort of interests in transactions. So that's a brief overview of all of the director's duties of a limited company. So yeah, I'll just discuss quickly what we've discussed today. We now know that there are 3 types of businesses. We have sole traders, partnerships, and limited companies. The former 2, as we have discussed, do not have the protection of limited liability, whereas a limited company does have this protection. This means that the company is a separate legal entity, and with this, it has the benefit that the company is liable rather than those who run it. The people who run the company are referred to as directors, and shareholders own part of that business. But as we discussed as well, the directors do not have the freedom to act as they please. They are governed by directors' duties, which are set out in the Companies Act, which limit their actions. So that's a brief recap of everything we've discussed today. I hope that you found this basic introduction to company law in the UK useful. There's obviously quite a lot more content that you could read about in your free time, and I would really recommend you to research the topic if you find it interesting. Thank you for watching, and enjoy the rest of your day. Bye.